thank you all for joining us this afternoon. We are excited today to talk to you all about tax. So today's webinar is actually called All About Taxes and What's New in 2025. Knowing that the tax world is increasingly complex and overwhelming at times, we hope that today you will hopefully come away with some things that you can do, some action items that you can maybe get accomplished before the end of the year or looking towards next year, and have a few takeaways. So I want to welcome my panelists along with me. I am Jody Robinson. I am Jody Robinson, Vice President of Tax Services. Sorry about that. Here at Mariner, I am joined today by Ellen Pfeiffer. She is a Director of Tax in our Manasquan, New Jersey office. Charlie Neiman, she is Senior Tax Manager in our Tulsa office. And then Christina Lynn, she is a Practice Management Consultant here at Mariner. So I'm excited to have this team joining me today to talk about everything tax. So we thought for today's agenda, we are going to be covering some last minute tax planning items for still this year. We're going to talk about some things that may or may not be expiring in the coming year, but just want to make sure everybody knows what's happening. And then we're also going to talk about topics that are hot in tax right now. So we're going to cover a lot of things. We're going to save some time at the end for Q&A. And then, hopefully we'll answer some questions for everybody. So to kick it off, we do want to talk about some things that we think need to be reminded here as we come into the end of the year. So, Charlie, one of the things that I am hoping that you can share with folks that are charitably inclined are some different things that they can maybe do here between now and the end of the year.
Yeah, so just to kind of give everyone a baseline, the standard deduction right now is $14,600 for single taxpayers, while it's $29,200 for those that are filing jointly. So, excuse me, in this current environment, it's become very hard to itemize and really, as your state and local tax deductions are limited to $10,000. That's your property taxes, your payroll taxes that go to the state. So to get above that bump, a lot of the times the rest of it comes from your mortgage interest or your charitable giving. So these are just some strategies that we've found that can work for those that are charitably inclined and that meets their goals. But they also want to go ahead and get that tax benefit. So the first one is bunching. So, say you normally give every single year to a charity close to your heart, but you still want to get the tax advantage. So maybe you combine 2 or 3 years worth of charitable donations. Sorry, guys. So that's something you can do is you can combine 1, 2, 3, however many years you feel comfortable. Go ahead and take that donation now, get the tax deduction, take it on your itemized deductions. And then, in year 2, you're not going to give any to charity and you're going to go ahead and take that higher standard deduction. Kind of similar, a donor advice fund is a tool that we can use too, that in a sense is kind of like bunching, but it's a little more of in a formal package. So you could put stock or other investments in cash into what's called a donor advice fund. You can put however much makes sense for your goals in there, and you can go ahead and take the deduction now. And then, year 1, if you want to give some of that money out of the donor advice fund to charity, you can. If you want to skip year 2, you can, and you can do more in year 3 out of that donor advice fund. And what's neat is you can go ahead and put like appreciated stock in there. That way you're not recognizing any gain to give, so you can give a cash donation to a charity. That donor advice fund can recognize the gain It can be invested within that donor advised fund. And then, of course, as long as it's a 501c3 that you're utilizing, there's really, it's a really neat tool to spread out those donations, but still get a deduction in the current year. And then one other thing we wanted to highlight was qualified charitable distributions out of an IRA. If you're 70 and a half, you can actually have your IRA administrator cut a check directly to your charity of choice up to $105,000 a year. And this is getting adjusted for inflation now. And this is a really neat tool because, first of all, it allows you to lower your income without taking an itemized deduction. And then secondly, it helps lower that modified AGI, which can be a really good tool for those that are trying to manage their income to get those lower Medicare payments.
Yeah, and with the QCD, there are some people who, because they're forced to take their RMD, they may not need to take the RMD. So this is a great alternative for them to be able to shave off some of their income and accomplish a charitable goal as well. So those are all great points.
And I think it's nice to note that the age for this is still 70 and a half. You don't actually have to wait until you're 72, 73, 75, which I think some people miss.
Yeah. In the Secure Act, they did not change that. So the QCD age is different from the RMD age now. So that's a great point. So Ellen, I'd like to switch over to you and talk about clients who may have realized some capital gains in market upswings this year, and what you and your team are actually doing to help them reduce those gains from a tax perspective.
Right. For clients like this, having an automatic loss harvesting strategy like MPEP, which is the Mariner Personalized Equity Portfolio, it's awesome because clients, it'll automatically realize losses as they are available. But if you have clients that don't have assets in that strategy, our advisors are actively looking to harvest losses where they can, especially if the client had a large gain event. And as we near year end, you do need to be cognizant of your resident state because not all states allow capital loss carry forwards. For example, New Jersey and Pennsylvania. But if possible, we try and get closer to a break even there. For states that allow loss carry forwards, you really can realize them and just bank them for going forward, especially if you know you've got a big event coming in the future that's going to create a capital gain.
Right. So now is the time of the year to be taking a look at what you've got in your account and whether there are any opportunities to realize some losses to offset those gains.
Exactly.
Charlie, there are some also opportunities for folks to still maximize retirement contributions between now and the end of the year. So can you maybe touch on some reminders there?
Take advantage of those 401ks. The limitation this year is $23,000 for most people, 50 and over. They get a little bit of a bump. They can take up to $30,500 into their 401k and reduce their income. Something really neat happening in 2025 is those that are 60 and up are going to get an extra little boost. So they're going to get instead of an additional $7,500, they're going to get an additional $11,250. So if you're, 60 or up, as soon as January 1 rolls around, up those retirement percentages, try to get a little more put away throughout the year, get that tax-free growth. The employer and employee max this year is $69,000 all in. So that's your 401k, your employee contributions, and your after-tax contributions if your employee retirement plan allows them. So definitely check out and see what your plan allows and see if you're maximizing that. And then, just some other kind of things that we can accomplish before year end that might make a dent on your taxes. 529 plan contributions. These are, they don't necessarily lower your federal income tax, but a lot of states allow for either deductions or credits for them. And they are accounts that you can invest and they grow tax free. So you're going to get a lot of bang for your buck as they grow tax free for your kids, your grandkids, nieces, nephews, whoever you set them up for. And what's kind of neat about those is, traditionally we think that they're for college students, but they can be used for tech schools. They can be used for K through 12 as well. So don't overlook those kind of non-traditional college uses for those accounts. And then lastly, there's still time to max out your HSA. If you or your family is on a high deductible health insurance plan, for those that it's just a self-only coverage, it's $4,150 annual. And then for a family, you can put up to $8,300 in there. So for those that have access to an HSA or they utilize those high deductible health insurance plans, these are really neat accounts. You can put the money in. They're going to reduce your taxable income for the year. You can invest that money, let it grow tax-free. And the hope would be to let it grow on the years that you can. Of course, it's really hard. If you've got kids getting braces or kids playing sports, maybe that's not your season to let it grow. But those years that you can let it grow, try to let it grow, because when you reach retirement age, you can pull money out to help pay for your Medicare premiums, your long-term care insurance premiums as well. And that will ease some of your retirement burden. And that way you're not taking money out of your taxable accounts to pay for those health insurance costs that you're going to need.
Yeah, it is a great savings vehicle for those retirement years to help with medical expenses there. And I did just want to clarify before we jump to the next question, the higher catch-up is specifically next year for ages 60, 61, 62, or 63. So it's only people that are turning those ages in 2025, which is another
very small window of opportunity.
Again, small window of opportunity, and again, in a way that only the IRS can make things a little more complex for people to try and keep track of. So, just wanted to make sure that everybody understood that it is certain ages for that. So, Ellen, on the retirement topic, what if I have traditional IRAs? What should I be thinking about between now and the end of the year?
We're doing two things. The first one, which is a big push in our office right now, is Roth IRA conversion analysis. We do a lot of modeling during the year to determine what, if anything, to convert to Roth IRAs, from traditional IRAs. We're watching for the tax cost as well as any incremental Medicare costs due to the increased income. You need to look at the full cost to convert and then compare it against the savings you're likely to achieve in the future. Based upon the number of years of income, those assets will permanently escape income taxation. And just keeping in mind that for Roth IRAs, a non-eligible designated beneficiary can wait 10 full years to distribute the Roth post-death of the owner. So the younger the IRA owner, the more impactful the results of the conversion. And we're doing a lot of this in the area between retirement and RMD, hitting original RMD age. And then once you hit RMD age, you have to decide the timing for your first distribution. So your first required minimum distribution must be taken by April 1st of the year following the year you turn 73. It's going to become 75 for those of us born in 1960 or later. But if you wait that long to take your first distribution, you're going to have 2 RMDs in 1 calendar year. So you need to assess if you really should take your first distribution in the year you turn 73. Unfortunately, because of the way the tax codes work or the tax rates work, they're incremental, and how our income is tied to the Medicare cost. Often the better answer is to take that first distribution in the first year so that you're not doubling up.
Yeah. And on the Roth conversion analyses that you're doing, I mean, a lot of people aren't necessarily looking to do it for themselves, but looking to do it for the next generation, like you mentioned, right?
That's 100%. When we're doing Roth conversion analysis, we are running on the assumption that this will be the last asset that our clients touch. So those are really going to be invested in a way for growth, hopefully quite a bit of growth, and that none of that will be subject to income tax.
Yeah, so it's estate planning as well.
It's an estate planning tactic. You're 100% correct. You're making a current gift by prepaying the income tax, and your beneficiary never will, because for anyone who isn't inherited an IRA, they're subject to estate tax and income tax. And if you have a taxable estate, the beneficiary doesn't end up with much at all.
Yeah. Yeah. So good things to consider. So thank you. So Christina, we haven't heard from you yet. So I'm hoping that you can talk a little bit about some gifting opportunities that people may want to consider.
Yeah, I got excited when Ellen started talking about estate planning. Yes, the 2025 updates also apply to some estate planning strategies. So the first is annual gifting. If you're interested in giving your kids or your loved ones money during your lifetime, you can do that up to $19,000 per person or $28,000 per person if you're a married couple. So that's one way. If you want to give more than that, if your loved one is in school, you can pay the education institution directly. If your loved one has medical needs, you can pay those costs directly to the medical institution. So yeah, and then the estate tax exemption number has also been affected for 2025. Now, per person, you can have exempt up to about 14 million, 13.99 to be exact. So that means you, as a married couple, you can give up to almost 28 million, pass that on to your heirs without paying a dime of estate tax.
Yeah, I mean, so certainly some things to be thinking about between now and the end of the year for sure.
Mm-hmm.
Charlie, we've talked a lot about individual tax-related planning. I'm hoping that maybe you can give those small business owners that we have out there some things to think about for their last-minute tax planning that they're doing for their business.
Yeah. First and foremost, kind of get a picture of where you're standing for the year. That way you have, good information to make these year-end decisions. Of course, equipment purchases are always on the table. If your business, could use the deductions and, use the equipment, year-end bonuses for your staff, or maybe even yourself if you're on a W-2. Of course, if you're on your company's payroll, you got to consider it might show up on the same return. So always take that into consideration. Of course, you got your retirement options. 401k stuff has to be established by the end of the year, and those things have to be funded by the end of the year. So you're on a little bit of a timeline there, but SEP contributions are a wonderful, wonderful tool for those that are self-employed, and especially if they don't have other employees, like they are a solo business. So SEP contributions can be made until the return is filed, and they're pretty significant. It's a $69,000 max this year, or 25% of the kind of net business. So that can be a substantial deduction that can still be taken. And of course, just to circle this all back with some of the estate planning that Christina mentioned, take a minute to kind of form your succession plan. Have you had your business valued? Or have you been in a building a really long time? Has the building appreciated a lot? And see if that's going to kind of throw you for a loop when it comes to estate planning as well.
Yeah. And then as far as retirement contributions, the SEP IRA, if you haven't gotten one set up now, is a great time to think about it, because as you said, you can take a deduction for 2024 and not actually have to fund that until next year. So that's a great opportunity to as I always encourage my clients to pay yourself first before you pay the IRS. So put money in your retirement account and lessen the amount of tax that you'll have to pay. So those are great points for our small business owners. Thanks, Charlie. So that wraps up some of the things that we recommend folks think about before the end of the year. One of the things that we also wanted to talk about was the potential sunset of the Tax Cut and Jobs Act. You'll probably hear it referred to as TCJA a lot. Set to currently sunset December 31st, 2025. Now, we all know that a few weeks ago, we had an election, and based upon the results of that election, there is some uncertainty as to whether that TCJA will actually be allowed to sunset. So I think it's potentially more likely than not that it won't be allowed to sunset in its entirety. And there may be some tweaks to it, but I think all of us on this panel and everyone in the tax world also knows that when it comes to taxes, you have to be prepared for anything and everything to happen, especially when it comes to Congress having to make that decision. So we did want to still touch on things that you should at least be aware of that could impact you if it is allowed to expire and sunset at the end of next year. So I'm going to throw this out to both Ellen and Charlie. From an income tax perspective, what do people need to know that's key items that are changing, and what conversations you guys are having with your clients right now? Charlie, I'm sorry. I apologize. No, go ahead.
We've been taking like a wait and see kind of approach, just because at this point, it's not really sure what's going to happen. The bigger push was really with estate planning and making sure that people got their foot through the door with an estate attorney if they needed one. With the president and Congress both going Republican, I'm really hopeful that we have a feeling for any potential changes sooner rather than later. I know I was talking to a client who tells me, the first 100 days, and she's confident it's 152 days and we'll know exactly what's going on. Because I don't think the entire act will be extended. I think we'll see some level of changes to it. And I think based upon those changes, what we'll do is focus on our traditional accelerating and decelerating income and deductions.
Yeah. Charlie, what are some of the things that are actually set to change?
Yeah. So if Congress does let these things expire, we're looking at probably an increase in tax rates. The standard deduction would lower back down. We would get our personal exemptions back though. So there's kind of some evening out there. The SALT deductions, they would probably come back into play. And that's your taxes that are paid through paid to your state through your payroll or your property taxes, those kinds of things. Right now they're capped at $10,000. And if that were lifted, that was a big cut for a lot of people. And then, like the QBI deduction, the qualified business deduction is set to expire too. So, we're kind of in a wait and see pattern, like Ellen said. It's hard to plan when we don't know what's really down the road. So we have to try to stick with our reality, whatever that is. But yeah, have a plan A, have a plan B, and hopefully we'll know sooner rather than later.
Yeah. But again, be prepared for anything.
Yep.
Christina, there are also some things on the estate side that could be impacted as well. And as you start to talk, I'm going to pull up a couple of visuals for you.
Yeah, the estate planning, I'd say it would be one of the larger impacts of the sunsetting. Like I mentioned earlier, individuals up to 14 million can pass on their wealth without paying a dime. Married couples up to 28 million. But as you can see here, this visual is demonstrating on the left-hand column that a household with, how much is this? This is $15.7 million in net worth. If they were to pass on, they would owe a little under $1 million in estate tax now. Now, the right-hand side of this visual shows that same amount of net worth, but what it might look like if the sunset does occur. They're going to, more than triple their estate tax due. So again, huge impact for those higher net worth households. And moving on to the next slide, your advisor can help you strategize for this. It does take some strategic planning to reduce that estate tax if that's something that you're affected by and interested in planning on. But your Mariner advisor can walk you through a decision-making process like what you see here to figure out what might be some estate tax strategies that would work in your situation, because everyone is different. Everyone has different desires and phobias and priorities, but there are a number of different ways to reduce that estate tax if that is something that you're going to deal with.
Yeah. And I mean, like you said, that's almost tripling the potential estate tax would be huge. And we've talked amongst ourselves that, I mean, don't delay estate planning in general. But I mean, certainly as we start to get a better handle on what's going to be taking place over the next year, one of the things that we've been telling our clients is don't wait to get conversations going with your estate attorneys, because if there is a sense that things could dip from an exemption perspective, there's going to be a long line at the estate attorneys' offices trying to get some things in order. So best practice is start thinking about the potential for those things now. So last things we wanted to touch on were some hot topics in tax right now. Hot topics, things that we're hearing with our advisors and our clients. And one of the things that we talk about a lot are Roth IRAs. Charlie, can you tell us a little bit about Roth IRAs and what some opportunities are?
Yes. So Roth IRAs, they're a great tool for building wealth. And then what kind of differentiates them from a traditional IRA is there's no required minimum distributions on them once you reach your 70s. And I'll say 70s broadly because it's a little bit of a different age depending on what year you were born. So right now, you can put up to $7,000 in a Roth IRA. And there are some income limitations. You have to have earned income in the year you put money into a Roth. And the income limitations are $146,000 for a single filer and $230,000 of income for a married filer. So even if you are at or above those income limitations and thresholds, don't let that deter you. There are still other avenues for you to still do a Roth IRA. You just have to be a little bit more strategic about it. So something that we see a lot for the high earners that we work with is it's called a backdoor Roth. And so essentially you can put money into an IRA and then move it over into a Roth IRA. And you kind of are serving the same purpose. You're just kind of doing it on a scenic route there. And then we have a lot of employers now are also offering in-plan Roth conversions. So if you are working for a employer that has a pretty robust retirement plan, a lot of times you can do in-plan Roth conversions through your employer and do a little bit each paycheck. So you can put in, do a percentage or a dollar amount, and you can kind of spread it out throughout the year. So the tax impact isn't quite as bad. You can do it a little bit here and there. And just, and I know we hear a lot about Roth conversions. And as Ellen talked about, those Roth conversions, a lot of times there's a lot of different factors you need to take into consideration if you want to do a Roth conversion. And so just make sure, you've looked at all facets, not just taxes, and really do your research, because if you start intermingling assets when you go to move money into a Roth, you can accidentally trip up and cause a little more pain than you had meant to. So approach with caution, do your reading, lean on the experts on your team, and in your circle of trust. But yeah, great tool, $7,000 a year, but there are some things everyone should be aware of. Something kind of new on the horizon with Roth IRAs is for people that have excess amounts in 529 plans. This is very new. Mm-hmm. You can put up to $35,000 from that excess 529 into a Roth. And so that's a really neat tool. You're still subject to that $7,000 a year limit. And there's some stipulations. The account has to have been around for 15 years. The beneficiary and the owner of the account need to be the same person. And you can only do $35,000 total. So if you're doing $7,000 a year, it's going to take you more than 1 year to get to that max amount. It would provide a great starting step for someone, it may be in their 20s or early 30s to have a Roth IRA that's going to grow for so long. But it's very new. The IRS hasn't released a lot of information on it yet. So just kind of keep that in your back pocket. And hopefully the IRS will start releasing information soon and give us a little bit more guidance on situations that aren't quite as straightforward.
Yeah, that 529 to Roth conversion is a great kickstart for a young wage earner just coming out of college to start their retirement fund with a Roth. I mean, one of the things that we talk about a lot is the earlier you can convert to a Roth, the better. So that's going to be a really great starter for young folks' retirement plans. But okay, so Ellen, the Secure Act 2.0. We've been waiting a while for some regulations to come out from the IRS, and we got them this year. So can you tell us a little bit about what the IRS helped clarify this year?
Yep, and I apologize because this is going to be super technical, so just bear with me. But we finally got some final regulations on this, which, as we all know, this happened in 2020, and there's been a lot of confusion as to who needed to take distributions out of inherited IRAs, and the IRS waived the requirement to take those required distributions for 21, 22, 23, and 24. Back on for 2025, there will be distributions. So 2025 is going to start the provisions of the Secure Act 2.0. They did indicate that our last waiver was 2024, so you want to know that these are coming. Just as a little refresher, there's two classes of beneficiaries. There's an eligible designated beneficiary and non-eligible designated beneficiaries. And the eligible designated beneficiaries are surviving spouses, children under 21, anyone who's chronically ill or disabled, and people who are not more than 10 years younger than the decedent. So you get that sometimes when you leave your IRA to a sibling or your parent. The eligible designated beneficiaries get to continue the old IRA stretch rules, noting that once the child becomes 21, the 10-year distribution begins. Non-eligible designated beneficiaries need to empty the account by December 31st of the 10th year following the decedent's death. So for an example, if somebody dies October 2024, the IRA must be emptied by December 2034. And this is where we had all the confusion, because when Secure Act came out, we all thought, oh, we've got 10 years to empty the IRA. And we are not required to take distributions. And then the IRS said, yes, you are, and then took this long to actually tell us. So what it is these non-eligible designated beneficiaries, the people that we're talking about in this 10-year window, they need to take their distributions annually if the IRA owner was in RMD mode when they passed away. RMD mode is defined as having lived to the RMD beginning date or April 1st of the year after they turned 73 or 72, if the case may be. So if the IRA owner was not in RMD mode at death, the beneficiary can wait the full 10 years to distribute the IRA. And again, that may not be the right answer for tax purposes, and this is where we're doing some modeling. But if your decedent was in RMD mode, you are required to take these distributions. And just because they had to throw a little wrench into the work here, in computing your first RMD for 2025, you need to start with the beneficiary's life expectancy that applied to the beginning of the 10-year period and subtract 1 for each subsequent year. So, for example, someone who inherited an IRA in 2021 from an owner who was in RMD mode. So, you know that they were in RMD mode and annual distributions are required. But the beneficiary didn't have to take the distributions for 22, 23, and 24 due to the waivers. So now we've got 7 years left to distribute this IRA, which must be fully distributed by December 31st of 2031. In this example, you need to look at the beneficiary's single life expectancy in 2022, and then you subtract 3 from that single life factor to reflect that we are 3 years into that 10-year period. And just a spoiler alert, believe it or not, there's a lot of really good online calculators out there, but always lean on your advisor. I do these calculations constantly, especially right now. Also, one little thing that what the IRS actually gave us as a blessing as well is when an individual passes away, prior to taking their RMD for any year, your beneficiary needs to take it out for you. And sometimes that's a problem because we can't get access to the accounts. The accounts get frozen. You have to run through a process to get them moved to the beneficiaries. The 2024 regulations provide an automatic waiver of the penalty for that missed RMD if you can't get it out that year. So the beneficiaries can have until December 31st of the year following death to take the missed RMD. But that means that you still have to take 2 RMDs potentially if you inherited from somebody who's in RMD mode. So there's an awful lot of technical calculations around the Secure 2.0 Act. The good news is we finally got some guidance. And I think, 2025 is going to be a little rocky, but once we get there, it should be quite a bit smoother.
Yeah, I mean, inherited IRAs are just so complex right now. So if you've inherited an IRA, you should be talking to your advisor and not trying to carve this path on your own because it's pretty complex. There's a lot of landmines and there's a lot of analysis to be done from a tax perspective. Like you said, it's not necessarily, I'm not going to take RMDs. I'm going to wait until the end of the 10th year because that could put you in a bad tax position. So just a lot to think about if you're sitting on an inherited IRA right now. Christina, you also have some information for us as it relates to qualified assets and digital assets.
Yeah. So I'm just kind of feeling bad because I'm going to pick on IRAs in the 10-year rule even a little bit more. So what we're seeing with high net worth clients is that their retirement accounts are sometimes becoming their largest asset. And when we're dealing with taxable accounts, which in 2025 will mean individuals with 14 million or more ish, or couples 28 million or more ish, those qualified assets or most retirement accounts become even uglier. It is not pretty, the amount of tax assessed in those cases. So those are just areas where you want to do some extra planning. Our advisors are trained on different ways to strategize for those, but it's just kind of something that we're looking for in particular to try to avoid that. Just to throw out one idea, if you're charitably inclined, there are some really cool techniques that you can do to address those that issue. But yeah, do you want to move on to digital assets? That's a hot topic.
It is a very hot topic. Just heard some people talk about in the hallway today.
I know, right? Now it kind of has some wind in its sails. But yeah, digital assets or crypto is not like traditional financial assets that you're used to dealing with. So there are, I like the term landmines that you used. One such case with digital assets, if you are kind of like testing your foot in those waters, are to be aware of triggering a taxable event. Again, doesn't work like normal traditional financial assets. You can trigger a taxable event or capital gains in this case by, for example, converting your crypto back into the US dollar or trading one crypto for another type of crypto. Or if you are like in the tech field and you're receiving payment in crypto, taxable event, you have to get that valued. What is that crypto worth? Which can be kind of tricky. If you're purchasing any like a goods or service with your crypto, if you're going to buy coffee with your Bitcoin, that's a taxable event. If you're doing crypto activities like staking, mining, if you're receiving an airdrop, again, lots of landmines that we're just not used to in like the traditional financial space. Another thing to watch out for in this hot topic of crypto is tax loss harvesting opportunities. Ellen talked about that, right? Tax loss harvesting kind of acts on steroids with digital assets because there's no wash sale rule. So you can sell and buy back the same crypto and harvest those losses to offset your gains without having to deal with a wash sale rule. So very different, kind of cool. And then the last piece of, again, just how different digital assets act is you need to be kind of on your game regarding tax reporting because we're used to sort of being, handed a neat form of what to report in our taxes and hand to our CPA. Not necessarily like that when it comes to crypto. And so you need to figure out how tax reporting is handled, where you're storing your crypto, and have a game plan for that.
Yeah, again, a really complex area that you just need to pay close attention to what the requirements are. So thanks for touching base on those. And then lastly, Charlie, I think we wanted to just touch very briefly on a hot topic for entity owners, the beneficial ownership information reporting.
Yes. So this is kind of popping up in the news more and more as I feel like the first deadline's kind of nearing. But this form is really meant to help the government identify both who directly and indirectly owns a company. And a lot of it has to do with states are typically companies are typically registered with the state, and that information the government just isn't really privy to it. So this is going to apply to most LLCs, corporations, entities, and be a little urgent with this. The fees and fines for not filing timely are just atrocious. So tell everyone at Thanksgiving too. It's not a tax report. It's ran through FinCEN. You can go to the fincen.gov website /BOI, and there's a lot of information. Speak to your business attorney about it, or maybe whoever helped you draw up your legal documents for your business about it. And then the filing deadlines. If the entity was created before January 1 of 2024, the filing deadline for those entities is January 1st of 2025. But if the entity was created during 2024, there's a 90-day window. And if the entity is created in 2025, the window goes down to 30 days. So treat it with a little bit of urgency. If you have any business entities, no matter how they're labeled, no matter how they're taxed, do your homework and try to get this done and off your list, because the fines are really bad.
Yeah. I mean, landmines, again, seems to be the appropriate.
Yeah, and the big concern is for those mom and pop shops that they don't have the support of the professional team. So try to get the word out to your family and friends as well.
Yeah. All right. Well, that's all of the content we wanted to make sure that we covered today. I want to check and see if we have some Q&A that our panelists can help with. So a few coming in about QCDs. Does the QCD strategy work for Roth as well as traditional IRAs?
You would want to do the QCD out of your traditional IRA, just because when you take money out of a Roth, you don't get that taxable income hit.
Yep. And then are there limitations on, number of QCD recipients and maybe how you distribute to multiple?
Yeah, I have clients that do multiple distributions a year, as long as you're under that 105,000 annual mark, and it is a 501c3 or a charity approved by your plan administrator, you won't have any problems doing multiple distributions.
Yeah. And administratively, I think you're typically directing the administrator of the IRA to actually cut the checks for you and send those directly to the charity. So
you do not want them sent to you and then you turn around and cut a check. Don't do that. Have your plan administrator cut a check from the IRA and send it straight to the charity.
Yes. Another question, I think we may have answered this, but let's just clarify. It says, will IRS require minimum distributions from inherited IRAs in 2025? Or is it still okay to defer the entire distribution until December 31st of year 10? So
it depends on if the original owner was in RMD mode when they passed away. So if they were in RMD mode when they passed away, no, you cannot defer. You have to take out something annually. And then if the IRA owner was not in RMD mode, you can wait the full 10 years. And again, work with your advisor, because that might not be the best income tax answer.
Yeah. Someone says, want to roll 529s into Roths after the 15-year holding period. Is the max that they can roll over still $35,000 lifetime? Yes, Charlie, you touched on that one. Let's see. Could you please repeat the gifting maximums per year starting 2025?
Yep, up to 19,000 per person. So married couples can give 28,000, for example, to a kid.
Mm-hmm. And then for 2024, it's still 18,000. So, got that one. Let me see. Under age 70. Says under age 70, taking RMD from an inherited IRA, can I do a QCD for my charity?
No, unfortunately, you can't do that with an inherited IRA. I think we could spend the whole hour just talking about IRAs.
Yeah. Does the Roth conversion count against the Roth contribution? income limit. Does the Roth conversion count against the Roth contribution income limit? No. So regardless of what your income level is, even though you're above that level to make a Roth contribution, you can still do a Roth conversion. For the 529 to Roth contribution, does the beneficiary need to have earned income in that year for us to contribute the 7K?
You are limited to
Yes.
that individual's earned income. So if they only made $2,000, that's all you can roll.
Yep.
So it could take, multiple years to get to that max 35K because you are limited to 7,000 or earned income, the max of those two.
Let me continue scrolling here. Some of these are duplicates. Oh, someone says, what was the last topic about for business reporting? It's under the new Corporate Transparency Act. They want anyone who owns a business entity, whether it's a single member LLC, an S Corp, a C Corp, certain trusts, has to file an information report with, it's called FinCEN. And it is basically so that the government can get an understanding of who owns the businesses that are registered throughout the country, essentially. So
Jody, question on that. Is this like a one-time thing that they're doing or?
So you would report it once now for all existing entities that are out there. You do have a requirement, though, if there are ownership changes or something changes with the entity name change, you do have to go back out and update it. And then if you create new entities, you would then have to, report that entity. So that's a great question. It's not a go back and report it every year. It's only then updated if there are changes. So again, a lot of complexities there as to who has to do it, what has to be reported. So we're, referring people to their business attorneys to make sure that they have a good understanding of what needs to be filed. Maybe a couple more questions. It says, can you use a 529 for grandchildren?
Yeah.
Absolutely. Can you use an IRA distribution to contribute to HSA and lower taxable income reported?
You can use any of your income. I think
any of your after-tax dollars.
As long as you're on a high deductible health plan, I think you can still do that.
And not subject to Medicare.
And yes, and not subject to Medicare.
Some of these are duplicates. We have a lot of please repeat filing alert for business entities.
I know.
If you have any questions, just go to fincen.gov, I believe.
Yeah, fincen.gov/BOI.
fincen.gov/BOI. Mm-hmm. Someone asked, can I do a Roth conversion with my RMD?
Nope.
No.
Oh, sorry. You must take your RMD and then you can do Roth conversions.
Couple other quick ones here. Can we give gifts to kids every year or just one time in your life?
Oh, give them every year.
Yeah.
My daughter's on this call. I'm hoping she's hearing that. Here's one that we didn't cover, but it says, besides paying taxes on the income and gains, what are the requirements to report foreign accounts? Oh, God.
And it must be done every year. Yes. If you have foreign accounts above certain thresholds, there are reporting requirements every year. So absolutely seek advice of your tax advisor if you have anything held in any type of foreign account. So with that, I want to give a plug here for our annual tax planning guide and quickly wrap up. So everybody who registered will be receiving an email with a recording of today's webinar, and it also will contain a link to our 2025 tax planning guide, which has some good information in it on things that you need to be considering. It's also going to be included in our upcoming December newsletter. And I would like to thank our panelists, Charlie, Ellen, and Christina, for joining us. Really appreciate you guys sharing your expertise and insights, and hopefully everyone who joined us here today was able to take away some things that they can actively implement in their tax planning, and want to thank everyone for taking the time to join us as well. So thank you.